In this video, we're going to be detailing the three major reasons almost every options trader loses money, and more importantly, the solution to each of these problems. I'm Seth Freuberg of SMB, and we are one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You've found the right place to learn. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan, and we're in touch with options traders from all over the world. And one of the most frequent complaints that we get is that people are trying to trade options profitably, but the exact opposite's happening. They keep losing money on options trades, and they're very confused as to why they just can't make it work. And in so many cases, the reasons that they keep losing money trading options is because they're missing some fundamental principles. And if they would just learn them, it could turn everything around for them, and they could begin pretty much immediately turning from being a frustrated, unprofitable options trader into a profitable one. And if this sounds like you, then you're going to want to stick around, because in this video, we'll be sharing with you the top 3 reasons that options traders we speak to are consistently losing money and how to turn that around. And so that's what today's video is about. Now, before we get into this important topic more deeply, if you're absolutely brand new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the options tips that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Okay, so the first huge mistake that options traders make is that they buy cheap options thinking that they're going to score an incredible return with very little risk as long as they make the right call on a stock's direction. Well, let's take a look at an example to show you why I'm afraid it's not that simple. For example, let's take a look at this chart of Tesla, where it closed at 181.02 on February 5th in that 181 to 182 area that the stock seemed to be finding recent support in. So suppose that you were of a mind that the stock would be likely to bounce from there. And so you pulled up an options chain expiring 11 days later on February 16th, and you went ahead and bought a 205 strike price call for 57 cents, which of course translates into you're paying $57 for that option. Well, that makes sense, right? Because that's cheap, only $57. And if the stock goes up, as you're predicting, then that could become very valuable, right? Because calls make money when a stock goes up, right? Well, unfortunately, it's not quite that simple. I want you to know something, and that is that column entitled Delta on this slide. And as you can see, the delta of that 205 call option is 8.30. Well, the delta of an option is a mathematical prediction of how much the options price is going to move based on how much Tesla stock itself moves. But the delta can also be used to express the probability that an option is likely to expire without reaching the option's strike price, which is in this case 205. And so the way that you can calculate that is to take 100 and subtract out of that the option's delta, and the result is the probability that the option will expire worthless, which happens when the call option expires at a higher strike price than the stock closed. So for example, in this case, the option had a 91.7% chance of expiring with no value on the day it expired. So in other words, you just bought something that has a 91.7% chance of having no value in 11 days. The trade doesn't sound quite as smart when you say it that way, now does it? Sure, it was cheap, but are you really excited about spending $57 and having a 91.7% chance that it will vaporize down to zero in 11 days? Well, in any event, that's exactly what happened, because 11 days later, on February 16th, the stock had actually rallied all the way up to 199.52. More than a 10% gain, by the way. But since that was the expiration date, the 205 call option simply expires worthless, because there's no value to an option to buy a stock at 205 when it's trading below that in the open market, and so you just lose your $57. And so even though you were totally right that the stock would bounce, and it bounced 10%, you picked an option that only had an 8.7% chance of having any value on the day the option expired. And so, yeah, you bought a cheap option, But even with your correct insight in the direction of Tesla, you lost all of your options premium. So the solution is actually pretty simple. Don't be lured into buying cheap options just because they're cheap. You have to understand the probabilities that the option will provide you with an actual options profit. And in this case, that probability was 8.3%, which is pretty terrible. The truth is, you would have been better off selling that option and making $57 by selling to another trader something that had a very small chance of working out. Now, if you do decide to sell low delta options, of course, always buy another option on the same options chain farther from the money and thus cheaper than the one you sold for protection should the trade go against you, so that the loss doesn't get out of hand in the unusual cases where the option does expire with value. Buying that protection, thereby creating what options traders refer to as a credit spread, is the much safer way to sell cheap options, which have a very high probability of expiring worthless and allowing you to pocket that options premium that you sold to someone else in this and in most other cases. Okay, so now let's move on to the second most common reason that people lose money trading options, and that is the fact that there are, in fact, pretty huge hurdles to your making money buying options, but most amateur traders don't understand this, and that can get them into some pretty frustrating circumstances. So for example, let's take that exact same example and trade it differently. Tesla, remember, was trading at 181.02, and so let's say that this time we decided to go out 18 days to the February 23rd options chain, and we bought the 190 call, which has a much higher delta, in this case 33.53, and we pay $3.70, which translates this time into a $370 cost. Because you know that buying low delta options is usually a mistake, you go ahead and buy the 190 options with that much higher delta, meaning that those options have this time a 66.47% chance of expiring with no value, and we're willing to take that chance because this time we have, logically, a 33.53% chance of the stock getting past our 190 strike on expiration day. And sure enough, the stock does get past 190, closing at 191.16 on the day the options expire. And so we were right. Tesla went up over 10 points, and we bought a call, and everything's just great, right? Because we were right, and the market closed above our call strike. So this is just going to be great, right? Well, not exactly. And here's why. You see, when you buy an option, you not only have to get the direction of the stock right, you also have to have that stock make that move in enough time so that the option hasn't expired before that move takes place. So in other words, you need to get the timing right, and the stock has to blow past the strike price by enough so that the value of the option when it expires is greater than what you paid for it. So let's see if that's what happened in this case. You see, on expiration day, this call options value was 1.16, right? Because the value of the right to buy the shares at 190 when the stock is trading at 191.16 is obviously 116, the difference between the strike price and the market price. And so you'll be able to sell that option for $1.16, which comes out to your receiving proceeds of $116 for selling that option. But remember, there's a problem here. And that is that you paid $370 for that option when you bought it 18 days earlier. And so therefore, even though the stock rallied past the call strike price before expiration day, so you got direction right and you got timing right, but it didn't blow past your strike price by enough to absorb the cost of the call option. And so you were totally right in every respect, basically, and you still lost money on the option because of its cost. And so when buying a higher delta option like this one, you really need to focus on how much the stock needs to blow past the strike price of the option in order for the trade to at least break even. And in this case, as you can see, that was 193.70, because at that price, the cost of the option is covered by the proceeds of the option if it gets to that price. And so if you think that break-even hurdle is not realistically achievable before the option expires, then it's a terrible idea, actually, to buy that call. In fact, If you think it's really unlikely, you'd be better off selling that call, as we talked about with the low delta calls in the previous example. But again, if you did so, you'd want to buy another call at a higher strike price to control your risk. In other words, you'd want to enter into a call credit spread. In any event, if your analysis does not include the cost of the option itself, you're making a huge mistake and setting yourself up for some pain and frustration. Let's now move on to the third major reason people lose money trading options, and that is that traders fail to understand options implied volatility. Now, what do I mean by options volatility? Well, to put it simply, it's the price that the options market builds into an option to be able to absorb the movement in the stock's price that the market is expecting. So, for example, let's go back to November 2nd, 2023, which was the day that Apple was going to be announcing its third quarter 2023 earnings immediately after the market closed. And as you can see, that day, the stock had closed at 177.57. And so let's say that on that day, we went ahead and bought a 177.5 Apple call expiring in the next day, pretty much right at the price the stock closed. And then simultaneously, we bought the 177.5 put expiring that next day also. Again, pretty much right at the stock's price, with the call going for $3.40 and the put going for $3.18. And as you can see from the calculation, the trade costs $658 to execute when you add up the separate cost of the put and the call. Well, when you do that, buying a call and put right at the stock's price, in both cases, you are executing what options traders refer to as an at-the-money straddle trade. And basically what you're saying with this trade is that you think the stock is going to move so much off of earnings that whether you buy a call or a put, one of them is going to be really valuable by the end of the next day, because if the stock goes down a lot, then the put will get really valuable. And if the stock goes up a lot, then the call will be really valuable. And so since earnings are coming up the next day, there's a really good chance that one of those two will be super valuable by the end of the day, right? Well, that's the theory behind the strategy anyway. So let's move to the next morning. And as you can see, the prices of both options had shrunk. In the case of the call, it went from $3.40 to 24 cents, which makes sense since the stock went down and the option is expiring that day. And so it would have to rally back past 177.5 to have any value. But the 177.5 put, well, that should be up a lot of money, right? Well, as you can see, it's not. It actually dropped to 304 when we originally paid 318 for it. Now, how does that make any sense? How can the put go down when the stock has gone well below the put strike price, which is 177.5, and the stock price is almost 3 points lower than it was the day before? How could the put have gone down? And the answer is what is known as the vol crush, which is short for what options traders refer to as the options implied volatility crush. And the vol crush occurs whenever a big event is over and something like earnings, which is an unknown, is now known. And so it's much easier to predict stock movement when a big mystery is now clearly known. And so option sellers don't have to build so much price into their options anymore because they have a much better idea of how the market is reacting to the earnings report than the flat out guess they were making the night before. And so even though the stock clearly moved down a meaningful amount, the options price went down because of the effect of the vol crush, the fact that the market sellers are at much less risk than before they knew the market's reaction to the earnings report. Let's move to the end of the day, and as you can see, with the options expiring, Apple closed at 176.65, so now we're in a position to assign a final value to the options comprising the straddle. And so starting with the call, well, that's easy. That's worth nothing because the right to buy Apple for a higher price than it's trading in the open market is obviously zero. And you calculate the put by subtracting the strike price from the closing price of the stock, which was 85 cents lower. And so that has a value of $85. But unfortunately, you paid $658 for the straddle. And so you lost $573. And so now you can see the devastating effect of vol crush on a long straddle when the stock moves modestly, as it did in this case after its earnings release. And while you will always see some vol crush after an earnings report, it gets extreme, as it did in this case, when the stock just doesn't react that much to earnings as it did in this case. And so what's the answer? Well, of course, in some cases, stocks will move big, and either the call or the put will blow up in value, and you can certainly win this trade. But the options market is generally pretty good at pricing the at-the-money straddle around earnings. And so many traders like to take the other side of this trade and instead sell the at-the-money straddle, which of course, in this case, would have resulted in the exact opposite, a win of $578 instead of a loss. But if you do that, it's very reckless to not buy a long call farther up the options chain and a long put further down the options chain to form what is known as an iron butterfly. So the trade can't get too out of hand if the stock does in fact have a massive move off of earnings. Those long calls and puts act as a kind of a stop loss for these trades, and it's pretty crazy not to buy that protection if you're going to sell instead of buy an at-the-money earnings straddle. And so what I'd like you to take away from today's video is that most people lose money trading options, basically because they don't really understand them. There are hidden risks in options, particularly when you are buying them, which, if you have a superficial understanding of options, can really cause some pain. So be like a professional options trader and make sure you get a solid education in options trading before you expose your hard-earned capital to its risks. Trading options has its dangers, as we just shared with you, but if you understand them and how to overcome those hurdles and turn them into opportunities, options trading can be incredibly rewarding as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.